Hello, my name is John Schmidt. I'm going to be the instructor for your course this semester, Introduction to Business Finance, BFIN265. I'd like to say a word for those of you who maybe have never taken an online course before. As many of you are aware, there are different teaching styles that different teachers will employ. Uh, Conversely, there's also different learning styles that every student has themselves. And some people are learners, they are auditory learners, they need to hear something. Some people are visual, some people need to be very tactile and hands-on to do things to learn. An online environment is a great way of learning, but you need to be very aware of your personal learning style because for some students, they will have to work a little bit harder to get what you need to get out of this course. Just like any course at a college level, you get out of it what you put into it, and it's no different. In fact, it's even greater in an online environment. If you try to skate by with the minimum amount of work, you will probably get the minimal amount out of this, and you may actually find this experience to be kind of a frustrating experience. However, if you're willing to employ all of the tools that are available to you, if you are willing to invest the time, and if you are willing to drop an email when you have a question or you are having a problem and allow me to intervene and to help you with that particular issue, I think you will find that your experience will be a much more valuable experience as a college student. Now, every week in this course is pretty much the same kind of format. Everything is going to be due on Sunday night by 10 p.m. There are a few exceptions, and you just need to read the syllabus and be aware of the syllabus. And I've tried to put those exceptions within within Moodle itself, but it's something that you just need to be aware of. I also have, in addition to these lectures of the chapter, in a few places I have inserted some other videos from another course, Personal Finance, where many of the same concepts or ideas, many of the same subject matters have some overlap associated with it. You will have, every time there's a chapter, you will have chapter assignments. I understand that this is an entry-level course, so some of the material you will find in the book, which can get very hot and heavy into detailed nitty-gritty financial calculations, is we are going to work on some of them in homework so that you have exposure, you have an idea, you have a chance to really kind of start to cut your teeth on them. But I'm not necessarily going to then ask you on a timed quiz to do those same problems. So you don't need to hyperventilate when you get to some of those kinds of things. The primary thing that we want to accomplish in this course is to really kind of build into you some critical thinking skills and layer in some really understanding some concepts, some principles, some terminology, some definition, and some how-tos that really kind of start you off on the journey of understanding finance within the business environment. At the beginning of every chapter, and we're not going to go through all these in detail, but beginning of every chapter, there are learning objectives that are there. And the reason I bring these up to you as to their existence is these are great. These little bullet points that you find at the beginning of the chapter are great little tools for you to be able to go back and as you are studying for a test is to look at a bullet point and say, okay, do I think I understand that bullet point relatively well? And if you feel really fuzzy about that or you don't really understand what the bullet point is, that gives you a good indication of something you need to go back and review a little bit more. Now, all of these slides that are included here, I've included those. These are the publisher's slides to the text itself. I have included those so you can go back and you can look at those on your own, and you can use those also for kind of one of those helps in studying for the exam itself. Now, as there are a number of things that I do wish to just discuss today as part of this lecture. And initially, I want to just go through some basic financial concepts. And much of what I'm going to talk about is repeated in the textbook. But just in every single chapter, I would strongly recommend you listen to the lecture first so that you begin to get some familiarity with what you're going to be reading. Then you dive into the textbook. You read the text itself. Maybe things will get reinforced. Maybe things will become clearer as you read them. And then as you go back and work the assigned problems, you'll still have an opportunity to then go back and forth back into the text to really start to get some exposure to that text and start to, in essence, inculcate the information of the text into your understanding. When we talk about finance itself, finance is really one of these very broad concepts that talks about any transaction in which money or a money-like instrument is exchanged for another money or money-like instrument. And whether it's the purchasing of a car, you're exchanging maybe cash down payment and a promise to pay them back with a promissory note, and you're exchanging that for the automobile itself. That is what finance is about. And so as we go through this, you just need to understand that finance is talking about the world of these kinds of exchanges that go on, one for the other itself. Is finance important? Well, that is kind of almost is, that's one of those, well, duh, they are important. But finance is important because anyone, and especially a course like this, anyone who is looking at starting a business or managing a business, of moving up and being in charge of a profit unit or a department or anything like that, they must have a basic understanding of finance. Even employees need to have a basic understanding of finance, because most of the time what an employee does has an impact on the financial status and nature of the company itself. As individuals, we need to understand finance, because we just deal in finance transactions throughout our entire life. Whether it's purchasing a home, it's investing, it's considering what we're going to do for retirement, it's addressing issues like what are we going to do with credit cards in our life. Any of those kinds of things become important for us to have this basic understanding. So as we go through a course like this, have in perspective in your mind, not that, well, I'm never going to have to deal with that, I don't have anything to do with that, and just let it so easily slip out of your memory. Kind of take it and say, this is something that may impact a portion of my life, whether it's personal or it's business in the future. Now, when we talk about these economic concepts of finance, we here in America operate primarily in a free market economy, not completely, as we'll mention in the text, but primarily it's a free market economy, and we talk about supply and demand. But whenever we talk about supply and demand, we just understand that a central theme of economics is one of scarcity, because very rarely do we have unlimited resources. In fact, there is no such thing on this earth as unlimited resources. And theoretically, when we talk about finance, we talk about economics, the more scarce a resource is, the higher price that resource can be sold at, or the higher price it would be purchased at. And there's really four types of scarce resources whenever we talk about finance itself. The first one is just what kind of put in the realm of natural resources. These are things, for example, like minerals and land, wildlife, cattle. I mean, those kinds of things are all considered to be natural resources, and we do not have an unlimited supply of those things. There's also human resources, which is really just talking about the mental and physical talents and efforts that are brought to any initiative or undertaking. There are capital resources, and there's really kind of two kinds of capital resources. One of them are really manufactured resources, manufactured assets, what are sometimes referred to as fixed assets in the accounting world. And then there's also those that are financial capital resources, things like cash, things like accounts receivable out there, or stocks or bonds or debt. Those are all items that are part of resources that come into the concept of finance. All have a limit to them. All basically fall under this umbrella of scarcity. And so, and when we also I want to mention the fourth one, which is entrepreneurial resources, which is just that person who brings to the table a combination of labor, of capital, of ideas to take an opportunity that they've identified and to make it successful for creating positive cash flow. This is one of the things that if this is something that you're going to be involved in the future, potentially being involved with a small business or starting your own business or looking at doing something on the side, I would strongly encourage you to consider as one of your options is to take the business management class, small business entrepreneurship, because much of what you are going to be looking at here becomes kind of a building block for looking at what we cover in that class. That's business management, BMGT 260 itself. As we look at the concepts and definitions, one definition that I want to just bring up, because it's something that you will hear, but it's not necessarily, if you're not in the finance realm, it's not something you necessarily think about that much. And it's the term called opportunity cost. And what opportunity cost is the highest value that is surrendered when a decision to invest funds is made. For example, and I'll give you just a really small example here so you can understand what I'm talking about. When you decide to go and spend $5 on a coffee at Starbucks, a latte or something, what you are doing is you are giving up the opportunity to put that money in a savings account and earn interest. So the opportunity cost there is, in essence, the interest that you have given up. Not only the $5 that you have given up, because you're never going to get that back, but also the interest on top of that. Now, yes, I understand the interest right now is 1% or 2% maybe if you're lucky, but it's not that great on a $5 cup of coffee. But when you start to look at that with bigger dollars, with bigger items that you're considering, that's what an opportunity costs. Just for example, if you go out and you decide to spend $20,000 to purchase a car, and I know they've got a picture of Ferrari here, so maybe it's a stock car Ferrari or something, but you spend $20,000 to buy the car. What the opportunity cost is that you could have spent that $20,000 to buy some stock. And if you think that stock was going to have an expected return of, let's say, 11%, the opportunity cost is that obviously the $20,000 that you could have spent on the stock, but it's also the value of the expected return of 11%. Also, if you decided to purchase stock rather than the car, and you say, well, there's an opportunity cost of my expected return is 11%. Well, the opportunity cost of buying a home might be that the value of the home might appreciate by 20%. Conversely, the opportunity cost there is, you say, well, maybe the expected increase in value is only 6%. And the difference between those, the 6% and the 20%, is what we call personal risk tolerance. If you, in essence, say, no, I'm not willing to give up that which is going to be a higher rate of return, then you start to factor in how you are going to make decisions on these opportunity cost items based upon your risk tolerance. And don't get that, you may be a little confused by what I just mention, but we're going to go through this in subsequent chapters themselves. And now, when we talk about savings, when we talk about retirement, when we talk about investing, it all begins with the concept of gross income. And let me just explain to you what the term gross income is. Gross income is basically all of the money you receive from all sources during the year. For most of us, it'll be wages and tips. It might be interest on savings accounts that you have or bonds that you hold. It may be income from real property, rental property you have. If you own your own business, the profit that you have. Even gross income might even include things like if you have an inheritance or you're receiving money from a trust fund or some of those kinds of things. Or you also have previous investments like stock that maybe you sold. All of these things go into the gross income, which is your cash inflow you have themselves. And so let me just introduce some terms to you that you will hear or you will see throughout this course. The first one is the term called disposable income. And what disposable income is simply taking your gross income and taking out your taxes. In other words, those things that we don't have any choice on paying taxes. That kind of gets taken out automatically, whether it's taken out of our paycheck or we have to pay in estimated taxes throughout the year. Uncle Sam has his hands out, and that's what he's going to get. Gross income is minus taxes is our disposable income. Our disposable income is what we use to begin to make decisions in our personal life or our business life of what we are going to spend on. If you were to take out of disposable income those expenses that are called fixed expenses, which are those things that they're there. They're going to happen every single month. Medical insurance probably falls under this. Car insurance, your utilities, your rent or your mortgage payment, your car payments, those things that just are automatically that you say, no matter what I make, those things I have to pay every single month. You take that from disposable income and that gives you your discretionary income. And that discretionary income is then what is the basis for what you then go out and you spend or you save, and you make those kinds of decisions. Now, when we talk about taxes themselves, one of the things I want you to understand is that there are different kinds of taxes that are out there, and there's really taxes fall under three basic forms of what is collected by the government. The first form is called progressive taxes. Well, there's three taxes: progressive, regressive, and proportional. Let me just briefly describe what each of those are. Progressive taxes is where a larger percentage of taxes paid as your income increases. Our current income tax system is a progressive tax. In other words, the lower your income is, you pay less of a percent of that income. And as you go up, let's say on the first $20,000, you're going to pay a certain percentage, and we'll just throw out a number, 7%. But then if your taxes increase to 30, or your income increases to $30,000, the next layer of taxes on income between $20,000 and $30,000 is taxed at 15%. And then if you make $50,000, the difference between $30,000 and $50,000 might be taxed at 25%. Or there's basically these different layers of percentage that increases. That's called a progressive tax system. A regressive tax system means a larger percentage of tax is paid as your income decreases. For example, our sales tax system is a regressive tax system. If you go out and if you go into a state, and I know we don't have sales tax here in Montana, but if you were to go into a state that has sales tax, is if you only make $15,000 a year and you go out and you buy a new TV and you pay sales tax on that, it doesn't matter how much money you make, whether you're making $15,000 a year or $100,000 a year, you're paying the same amount of sales tax on that TV. But that that dollar amount of sales tax that you're paying on that TV is a much larger percentage of your income if you're making $15,000 than $100,000. That's called a regressive tax. There's also what's called a proportional tax. And this is a percentage of tax paid remains the same at all levels of income. A perfect example of this is our Social Security and Medicare withholding from our taxes. For most of us, it's the percentage is the same whether we make $20,000 a year or we make $70,000 a year. Now, the cutoff, and I believe it's currently still right around $110,000 or so. For people that make more than $110,000, they don't have to pay FICA anymore after the first $110,000 of income. So at that point in time, if they make more than $110,000 of income, that really becomes what in essence would be considered a regressive tax itself. So as we talk about this whole concept of income and the interplay with everything out there, one of the things that we want to touch on in this chapter is just the factors that affect interest rates. And let me just kind of explain a couple of different things, because there's really a number of factors that the text talks about that affect interest rates. The first factor is really the supply of money that is saved. And what this is that's primarily the total money that is placed in checking accounts, in banks and savings accounts, in money market mutual funds. And these are macroeconomic concepts, and we're not going to get too far down into the weeds here because this can get very complicated very quickly. But basically, when you really think about this and you think about how this affects interest rates, as prices increase, the quantities supplied for products will increase. Think about this. If you're sitting there and you're selling turnips and the price of turnips start to go through the roof, well, turnip farmers are probably going to try to grow more turnips because they get more, because as they sell that turnip, they get more money per turnip than they did before. And this is kind of closely related to the supply of money. Another reason that affects interest rates is the demand for borrowed funds, which is all the money that is demanded in our economy at a given price. And as interest goes down, borrowing goes up so that they can purchase more. Conversely, as interest goes up, borrowing is going to go down because people are less inclined to borrow because it gets pretty expensive. And these two factors of the supply of money saved and demand for borrowed funds really begins to have an effect on our money supply in our economy. Now, another factor here, which isn't mentioned on the slides, but it is mentioned in the textbook, is just inflation itself. And inflation occurs within an economy, within a free market system, when demand exceeds supply. The CPI, the Consumer Price Index, begins to go up, and that Consumer Price Index represents a market basket of goods. And as inflation increases, that's going to have an effect on interest rates. Now, another factor that comes into play in our economy in the United States is just Federal Reserve policy with respect to the money supply. I had mentioned before that our market is primarily a free market system, but it is not completely a free market system, because if it were a free market system, when you go back to the previous slide, everything would be created and generated by the supply of money that is saved out there and the demand for borrowed funds. There would not be any other factors coming into that. But we like to have our fingers in the pot because we kind of want to control the economy and what's happening to the economy. And so we do that by changing policies through the Federal Reserve that impacts the money supply. And we use this to expand or contract economic activity in the United States, which then affects interest rates within here. When we talk about the whole concept of factor number 5 of risk, We're really talking about the probability of what an actual return will be and how that is different from an expected or desired return. Obviously, the higher the risk, the higher the probability that we won't receive the return that we were hoping or that we expected, because it's going to fluctuate that much more. There's really two kinds. When you look at risk factors out there, there's really two kinds: systematic and unsystematic risk. Systematic risk is that risk associated with economic, political, sociological changes that affect all the participants on an equal basis. The text uses an excellent example of September 11th, and just how September 11th had this ripple effect on the economy in the airline industry. Because right after September 11th, people were afraid to fly. And because they were afraid to fly, that means that business dropped way off. And because business dropped way off, airlines had to then have a whole bunch of layoffs. And because they were trying to generate more business, there was this airfare wars that were going out there. And this was kind of across the board within the airline industry. All of us who flew received the benefit of those lower airfares, easy to say. For those who worked with the airline industry, many of those people experienced the layoffs associated with that. But taking that same industry and looking at an unsystematic risk, there was a risk that especially there was very unique to that particular industry. Another example of unsystematic risk is just competition. As competition increases, you may see more fluctuation of the risk factors associated with that particular industry. For example, if you were to invest in the coal industry is under a lot of environmental pressure that is impacting operation results, it's impacting stock values, it's impacting just the underlying values of the companies themselves. The risk is going to become greater there within that one particular industry and not necessarily spill over into other energy companies. In conclusion, when we talk about the basic finance concepts, these are always needed before talking about goals and business ownership, or even contemplating what plans or strategies are going to be, whether as an individual or a business.